For much of the 20th century, General Motors, GM, stood as a symbol of American industrial might. The company once famously claimed it was good for the country if it was good for General Motors, a reflection of its towering role in job creation, engineering breakthroughs, and the broader U.S. economy. Yet in the first decade of the 21st century, a mix of spiraling legacy costs, intense foreign competition, strategic missteps, and a global recession pushed GM to a point that once seemed unthinkable: a government-assisted bankruptcy. By mid-2009, the automotive behemoth had filed for Chapter 11, marking one of the largest industrial bankruptcies in world history. Today, we'll explore the decades-long arc that led GM to this precipice, the political and financial maneuvering that saved it, and the lessons that continue to reverberate across manufacturing and government policy. To appreciate the gravity of GM's bankruptcy, one must first recall the heights the company once reached. Founded in 1908, GM quickly expanded by acquiring established carmakers such as Buick, Oldsmobile, Cadillac, and others. By the 1920s, under the guidance of Alfred Peeves Sloan, GM refined a brand differentiation strategy: Chevrolet for entry-level consumers, Cadillac for luxury buyers, and various divisions in between. This approach, paired with yearly styling changes, propelled GM to become the world's largest automaker. After World War II, GM's dominance soared further. The company's innovations in manufacturing efficiency, design, and engineering helped it corner a massive portion of the U.S. car market. By the 1950s and 1960s, GM was an economic powerhouse employing hundreds of thousands of workers. Its enormous plants in places like Flint, Michigan, Detroit, and elsewhere were synonymous with stable, well-paying jobs. The company's policy to offer generous health benefits and pensions aligned with the broader social contract of mid-century American manufacturing. At its zenith, GM's market share in the U.S. once eclipsed 50%. The brand portfolio was so expansive that the name General Motors evoked images of a monolithic enterprise that represented American ingenuity on the global stage. However, amid this success, GM's future weaknesses were already forming. A cozy relationship with the United Auto Workers (UAW) union led to lucrative labor contracts that, while beneficial to workers, placed long-term financial burdens on the corporation. Pension obligations and healthcare commitments for retirees accumulated over time, slowly bloating GM's cost structure. Meanwhile, overseas competitors were perfecting lean manufacturing techniques and producing smaller, more fuel-efficient vehicles, an emerging trend GM overlooked as it banked on the continued popularity of large sedans and SUVs in North America. Though GM remained profitable and influential through the 1960s, the 1970s introduced pressures that would gradually erode the company's American dominance. Chief among them was the arrival of foreign automakers, particularly from Japan. Toyota, Honda, and Nissan all began exporting affordable, high-quality compact cars to the United States. They employed lean production methods, pioneered most famously by Toyota, that allowed them to lower costs, streamline operation, and quickly adapt to consumer preferences. When the OPEC oil embargo struck in 1973 to 1974, and again with another energy crisis in 1979, gas prices skyrocketed. Suddenly, American buyers clamored for more fuel-efficient models, precisely the niche Japanese automakers excelled at. GM's product line, oriented around large sedans, station wagons, and, later, full-size trucks, found itself less appealing to price-conscious consumers. Although GM tried to respond, many of its attempts at smaller vehicles, like the Chevrolet Vega in the 1970s or certain compact models in subsequent decades, were plagued by reliability issues or failed to match the refinement of Japanese imports. As the 1980s began, GM was still large and profitable, but cracks in its foundation had grown. Mounting pension obligation, an aging workforce, and stagnating U.S. market share eroded the surety it once enjoyed. Attempts to restructure or innovate, like the creation of Saturn as a youth-oriented brand, yielded mixed results at best. GM also wrestled with internal bureaucracy. Its multiple divisions sometimes competed or overlapped, draining resources and dulling the brand identity that had once been so precisely managed. Although the 1980s and 1990s introduced new challenges, GM also found opportunities, particularly in the SUV boom. Vehicles like the Chevrolet Suburban, Tahoe, and GMC Yukon were high-margin sellers in the U.S., where fuel prices remained relatively low during much of this period. Profits from these trucks and SUVs helped GM sustain its sizable pension and healthcare obligation. Yet this reliance on profitable gas guzzlers again left GM vulnerable to potential spikes in oil prices and shifts in consumer preferences. Meanwhile, globalization also accelerated. With the North American Free Trade Agreement, NAFTA, and other trade deals, GM sought to lower costs by establishing plants in Mexico and other countries. The company hoped that broader international markets would bolster sales. However, foreign manufacturers, especially Japanese, Korean, and eventually European and Chinese firms, continued capturing more of the global auto sector with well-built, innovative vehicles. By the turn of the millennium, GM faced a new wave of complexities: stricter emissions regulations, growing competition, and changing consumer tastes in design and technology. The company's size and entrenched culture sometimes hindered nimble responses to these trends. Executives made moves to rationalize the product line, phasing out Oldsmobile, exploring partnerships, but the core cost structure remained unwieldy. Healthcare and pension costs, known collectively as legacy costs, added thousands of dollars to the cost of each vehicle GM produced, putting the company at a significant price disadvantage compared to leaner rivals. GM entered the early 2000s trying to fend off repeated warnings about its financial stability. Although it still ranked as one of the world's largest automakers by volume, its U.S. market share had dropped precipitously from the glory days. In an attempt to maintain sales, GM, alongside Detroit's other major carmaker, offered deep discounts, 0% financing, and incentive programs. While these promotions propped up short-term sales numbers, they further eroded profitability and brand image, training consumers to wait for deals rather than pay premium prices. Simultaneously, GM's healthcare obligations ballooned. Under long-standing union contracts, GM was on the hook for healthcare coverage for hundreds of thousands of retirees and their dependents. Rising medical costs in the United States meant GM was spending billions annually on benefits unrelated to active production. Some observers argued that GM had effectively become a healthcare provider that also built cars on the side. Analysts and credit agencies expressed concerns about GM's debt load. The brand had relied on corporate bonds to keep capital flowing, but as profitability waned, ratings agencies downgraded GM's debt to junk status in 2005. This increased borrowing costs and signaled deeper trouble ahead. CEO Rick Wagoner attempted to implement restructuring measures, closing plants, offering buyouts to reduce the workforce, and negotiating concessions from the UAW. But these steps, while significant, were not enough to counter the broader economic and structural pressures. A combination of factors, rising oil prices, the subprime mortgage meltdown, and the subsequent global financial crisis, dealt fatal blows to GM's precarious stability. In 2007 to 2008, gasoline prices spiked above $4 per gallon in many parts of the United States, rapidly deflating consumer appetites for large SUVs and pickup trucks. At the same time, the financial crisis dried up credit market, making it difficult for consumers to secure auto loans. With vehicle sales plummeting and the cost of capital skyrocketing, GM found itself rapidly running out of cash. By late 2008, GM's liquidity crisis was severe enough that the company publicly acknowledged it might not survive without substantial external aid. Fears of a disorderly bankruptcy rose, prompting concerns that hundreds of thousands of jobs, spanning factories, suppliers, and dealerships, would vanish if GM collapsed. The scale of potential economic damage was so immense that it triggered alarm among federal policymakers, who were simultaneously grappling with the collapse of major financial institutions like Lehman Brothers. Amid the unfolding crisis, the Bush administration authorized emergency loans to GM in December 2008 through the Troubled Asset Relief Program, TARP. When President Barack Obama took office in January 2009, his administration intensified oversight and demanded deep restructuring in return for additional assistance. The government formed an auto task force to vet GM's turnaround plan. Concluding that the plan was not sufficiently transformative, the task force forced CEO Rick Wagoner out of his position in March 2009. Fritz Henderson replaced him, but the real pivot came when the administration directed GM to pursue a quick-rinse bankruptcy process, funded by billions of federal dollars. That bankruptcy filing officially occurred on June 1, 2009. GM listed assets of around $82 billion and debts exceeding $170 billion, making it one of the largest industrial bankruptcies in U.S. history. The federal government pumped in close to $50 billion overall to keep GM afloat during reorganization, a move that provoked controversy over government motors and whether Washington should bail out a private corporation. Nonetheless, supporters argued the bailout was necessary to prevent cascading job losses and save an American manufacturing linchpin in a fragile economy. Under bankruptcy protection, GM rapidly restructured into what was dubbed the new GM. The process took only 40 days, a stark contrast to typical drawn-out bankruptcies, thanks to government funding and legal maneuvers. This newly formed entity purchased the bulk of GM's viable operations, leaving behind old GM, which contained unwanted assets, liabilities, and contracts to be liquidated. Several storied GM brands were discontinued in the process. Pontiac, Saturn, and Hummer were all phased out, while Saab was sold off. Chevrolet, Buick, Cadillac, and GMC remained as GM's core North American market. Multiple factories and dealerships closed or consolidated, shrinking the company's footprint across the country. The UAW also agreed to concessions, particularly regarding healthcare trusts and wage structures for new hires, to reduce GM's labor costs moving forward. Meanwhile, the federal government and, to a lesser extent, the Canadian government emerged as key shareholders in new GM. The U.S. Treasury eventually owned about 60% of GM's equity, with the UAW's retiree healthcare trust, bondholders, and others holding minority stakes. While this arrangement kept the company running, it ignited a fierce debate over government intervention in private industry. The GM and Chrysler bailouts became a hot-button issue. Critics derided them as corporate welfare, contending that incompetent management and unsustainable union deals had led to GM's collapse, and therefore taxpayers shouldn't foot the bill. They further argued that a standard bankruptcy, without government backing, would have forced more radical reform and might have enabled new market entrants. Proponents countered that letting GM dissolve would devastate a broad ecosystem of suppliers and dealers, risking an economic chain reaction in the midst of an already dire recession. The auto sector had historically employed vast numbers of skilled and semi-skilled workers, not to mention a huge network of parts manufacturers in the Midwest and beyond. They claimed the bailout, though imperfect, was necessary to preserve an essential cornerstone of American manufacturing and innovation. The controversy also raised existential questions about industrial policy. Had America abandoned laissez-faire principles to save a legacy manufacturer? Or was the bailout a pragmatic measure, an emergency step to ensure the survival of a vital national industry? Over time, public sentiment remained divided, although many workers and communities reliant on the automotive sector expressed gratitude for what they saw as a lifeline. Once new GM emerged from bankruptcy protection, the company moved to shore up its image and operation. It went public again in November 2010 with one of the largest IPOs in history, raising $20 billion. This helped the U.S. Treasury begin recouping some of its investment, although the government continued to hold shares for a few more years. By the time the Treasury fully exited its GM stake in 2013, taxpayers had recouped much of but not all of the bailout funds. Estimates vary, but losses to the U.S. government may have run into billions. On the operational side, GM's new leadership streamlined vehicle lines and improved engineering. It introduced more fuel-efficient models, like the Chevrolet Cruze and later the Bolt EV, invested in technology partnerships, and modernized manufacturing processes. The company sought to shed its old reputation for subpar quality and timid design by embracing advanced safety features, new styling, and progressive powertrain. Although it retained a strong focus on pickups and SUVs, remains of the old GM strategy, vehicle reliability and consumer satisfaction ratings rose, helping GM recapture some lost brand credibility. From the vantage point of the 2020s, the GM bankruptcy still resonates as a watershed in corporate and government history. It underscores the fragility of even the most iconic industrial giants when faced with changing market dynamics and burdensome legacy costs. It also highlights that government intervention can, under specific circumstances, rescue a failing enterprise that might otherwise drag the larger economy deeper into recession. Yet the debate over moral hazard remains. Critics note that by saving GM, the government potentially encouraged less disciplined risk management among other corporations that assume Washington may step in if they're deemed too big to fail. Meanwhile, others point out that GM has largely paid for the rescue with drastically altered labor contracts, a downsized footprint, and the partial recovery of taxpayer funds, suggesting the measure was not a free pass but a conditional reprieve. Moreover, the GM case offers insights about the pace of technological shift. If a company grows complacent, banking on a product line too heavily or failing to foresee shifts like rising fuel efficiency requirements and overseas competition, it can find itself on a path to irrelevance, no matter how dominant it once was. GM's travails also reveal the complications of large pension and healthcare obligations in an era of global competition, raising broader questions about social welfare responsibilities historically placed upon employers. Finally, as the automotive industry now grapples with the rise of electric vehicles, autonomous driving, and tech-led disruption from companies like Tesla, Google's Waymo, and emerging Chinese EV makers, GM's bankruptcy remains a cautionary narrative. It reminds the industry that staying at the cutting edge of innovation, maintaining flexible costs, and adapting to consumer preferences are not optional if a company aims to endure. In the years since 2009, General Motors has staged a partial rebirth, occasionally reclaiming the title of the world's largest automaker, though it regularly trades places with Toyota and Volkswagen. Its product lines now include electric vehicles, and it has invested in autonomous driving through projects like Cruze. The old GM that once sustained a complex network of competing divisions, lavish labor agreements, and a complacent attitude toward emerging competition has, at least in part, receded into history. Yet the specter of 2009's bankruptcy remains a reminder of how close a century-old industrial pillar came to outright collapse. While GM's example demonstrates that government-assisted restructuring can preserve critical jobs and skills, it also underscores that no enterprise, regardless of size or heritage, is guaranteed security in a rapidly changing global marketplace. To survive and thrive, an automaker must blend technical excellence, forward-looking strategy, cost discipline, and a deep understanding of consumer trends. GM's 2009 bankruptcy revealed the consequences of ignoring these imperatives for too long and the potential for renewal when a crisis forces radical change.